Hello again, I'm Michael Hainsworth, in for Mark Bunting. David Burrows is here on Market Call as we talk to the President and Chief Investment Strategist at Barometer about your North American large caps. We're going to go to the mailbag before we go off to the phone lines at 1-855-326-6266. Kunal had emailed you in on Couche-Tard asking if it's too late to get in, or has it run out of steam after its recent acquisition, and should I stay away?
Right. So on Couche-Tard, let me come at it from the way that we at Barometer look at the world. Our view has been for quite some time that what is driving valuations in the developed markets is the change in the energy market. We have come into a world where energy is an asset that is predictable to find at a relatively predictable cost. And that is really great for a consumer. So one of the key themes in this market over the last 2.5 years has been the consumer sector, and consumer discretionary in particular. As energy prices came down, this was a great thing for consumers, and especially for low-end consumer discretionary companies, and Couche-Tard would fit into this camp, right? Spend an extra few bucks when you fill up your car with gas to buy, a chocolate bar and something else. Couche-Tard within that group has done a great job of building their business. So I would say on the demand side, things are getting better. But on the other side, they've made great acquisitions and they've been very good at executing. Now, in the Canadian marketplace, we have a relatively small consumer sector. In the US, it's a big one and lots of choice. So Couche-Tard has been really a go-to stock for Canadian institutional investors. It's a $20 billion market cap. It's a very large company. This acquisition that they've most recently made gives them more playing room in front of them to continue to consolidate and cut costs. So I think that it looks very attractive within the scheme of the sector, and the sector looks very attractive within the market.
71% of Couche-Tard's revenue stream comes from the gas bar out front, but only 42% of it ends up flowing to the bottom line. Are you concerned about its exposure to the lower margin gasoline business?
In all of these, in all of their businesses and in all of the convenience stores that have gas bars attached, the money is made inside the store. It's not made in the gasoline. Although, if you listen to the CEO be interviewed, he would say he wants to be making money at the gasoline as well and believes that he can. I think that this is one of the obvious places that the consumer spends a little bit more money, and that is playing through into the numbers.
All right, thank you very much, Kunal, for the email. Off to the phone lines now. Dorothy in Hamilton, hello.
Hello. My question is kind of a general one. It seems like we're in a bearish market right now, and I hold several oil stocks, and most of them I'm suffering a loss on, and I'm wondering if I should get rid of all of them. Like, I've got 5 oil stocks, plus I've got Pembina. And I'm just wondering if I should get rid of everything, keep some of them, and where is a good, safe place to put your money?
Right. So, Dorothy, there's a few points to your question. You've referenced that we're in a bearish market. I would disagree with you. I think that we're actually in a very attractive market for specific sectors. Sadly, energy is not one of them. At Barometer, we have virtually a zero weight in energy right now, and I do believe that there is risk in the commodity price. A lot of these stocks rallied between March and the end of May as oil came from 45 to 60. We believe that it is unlikely prices stay in and around these levels, that there's lots of supply coming at the market, and likely you're going to see those prices back off. I would certainly reduce exposure to the energy group as it is right now. In a couple of the funds that we manage, we're actually short energy, and I think that there is some real risk there. Canadians, sadly, tend to have more energy exposure than people do in other countries. There are sectors that really benefit in this environment. The consumer sector is one that I talked about. Consumer discretionary companies like Disney, like Starbucks, are big beneficiaries. Companies like Amazon, specifically in benefiting from the secular growth in online sales. Also healthcare, benefiting from demographic shifts and an improving U.S. domestic economy. These are areas I would focus on. And frankly, if you're worried about the market getting more difficult, and I don't believe that to be the case, healthcare would be a more defensive area for you to focus.
All right, Dorothy, thanks for the call from Hamilton. Let's go to Bev in Saskatoon. Hi, Bev.
Hello.
Welcome.
I've had Interpipe for about 2 years now, and I was just wondering if that's still a good place to be.
Right. So, Bev, within energy infrastructure is the most defensive part of that market. For those that watch, for about 3 years, this was the biggest sector exposure that we had at Barometer in our various mandates. The first part of this bull market was driven by the companies in the energy patch that benefited from this boom in production in the U.S., right? They now generate 90% of their own oil. That changed gears last summer as supply met demand. And I think the world we're living in today is a world where you want to focus on what wins in a low-cost energy world. So while the pipelines are more defensive, I think you are running into a headwind. It's possible that supply growth may slow, given where prices are. And so I think that it makes the pipelines less attractive, and they'll have lower dividend growth, which means that they can trade at lower multiples because the future is less predictable. So if you have to own something for yield, you're going to get paid your dividend. I think you should expect lower dividend growth, and there may be more attractive sectors that are more economically sensitive that benefit from the impact of low energy prices as opposed to being hampered by it.
Interpipeline trades with a 4.9% dividend yield. That's 12.25 cents shelled out every month. Bev, thanks for the call from Saskatoon. We're taking a short break. David Burrows is our guest from Barometer Capital Management. We're talking North American large caps. We still have lines open at 1-855-326-6266. When we come back after this short break, we'll talk about the Canadian banking sector.